Every founder hears the word runway thrown around constantly. It's the metric we obsess over, but what happens when that runway dries up overnight? I'm not talking about a slow decline, I mean a sudden, gut-wrenching halt. One day you have a clear path, the next, you're staring at a cliff. Let's talk about building a real safety net, a financial fortress that can save your business from those unexpected shocks. My name is Alex, and I learned this lesson the hard way. My first startup was humming along nicely. We were closing deals, growing the team, everything seemed perfect. Then, our biggest client delayed a massive payment. Just like that, our cash flow seized up. Payroll was due, rent was due, and we had nothing. We were forced to take a high-interest line of credit just to survive. That decision cost us 15% of our profit for the next year. It was a nightmare that nearly sank us. After surviving that crisis, I swore I would never be in that position again. I became obsessed with creating a bulletproof financial cushion. The system I developed is what I call a rainy day fund, and it kept my next company afloat through to full years of zero revenue during a market downturn. It wasn't magic, it was a strategy. Today, I'm going to share the 3 proven steps you can implement right away to build your own. So, let's dive into the first, and perhaps most crucial, idea: allocating a fixed percentage of every single revenue inflow. This is the bedrock of your rainy day fund. It's simple, it's automated, and it's incredibly effective. The concept is to set a predefined rule for your business finances. For example, you decide that 10% of every invoice paid, every sale made, every dollar that comes into your business will be automatically transferred to a separate savings account. Not just any savings account, though. We want this money to work for us, so we'll put it in a high-yield savings account or a money market fund. These accounts offer better interest rates than a standard checking account, but are still liquid enough to access when you need them. Now, the key here is the word automatic. We are creatures of habit, and it's far too easy to say, "Oh, I'll move the money later," and then never get around to it. To make this truly effortless, you need to leverage technology. Most modern accounting software like QuickBooks, Xero, or Wave has a feature called bank rules. You can set up a rule that says, when a deposit from a customer hits our main checking account, automatically transfer 10% to our rainy day savings account. You set it up once, and it works for you in the background forever. You don't have to think about it, you don't have to remember it, and you can't talk yourself out of it. It just happens. Think about the power of this over time. 10% might not sound like a lot on any single transaction. If you get a $1,000 payment, $100 goes into savings, you probably won't even miss it. But over the course of a year, these small, painless contributions add up to a significant buffer. If your business does $250,000 in revenue, that's $25,000 set aside. For many small businesses, that's 2 or 3 months of operating expenses right there. You've built a multi-month safety net without ever feeling the financial pinch. It's the definition of paying yourself first, but for your business's future security. This single habit is the difference between a business that's fragile and one that's resilient. Okay, so you're automatically siphoning off a percentage of your revenue. That's fantastic. But where you store that money is just as important as saving it in the first place. This brings us to idea number 2. Building a tiered liquidity ladder. A common mistake is to just dump all your savings into one account. The problem with that is you're forced to choose between immediate access and getting a good return. A checking account gives you instant access, but earns 0 interest. A long-term investment might offer great returns, but locks up your cash. The liquidity ladder solves this dilemma by giving you the best of all worlds: speed, access, and growth, all at the same time. Here's how it works. You split your rainy day fund into 3 distinct tiers. Tier 1 is your emergency response fund. This should hold about 1 month's worth of essential operating cash. Think payroll, rent, key software subscriptions. This money needs to be instantly accessible, so you keep it in a separate, dedicated checking account. If a crisis hits on a Friday afternoon, you can wire funds immediately without waiting for a bank to open or an investment to clear. This is your immediate access, break glass in case of emergency money. Next up is Tier 2. This is your midterm buffer. It should hold an additional 2 to 3 months of operating expenses. This tire is all about balancing accessibility with a bit of growth. A high-yield savings account is perfect for this. You can typically access these funds within 1 to 2 business days, which is fast enough for most situations that aren't an absolute 5-alarm fire. Meanwhile, the money is earning a decent interest rate, compounding and growing your safety net while it sits there. This is where the bulk of your initial savings will live as you build the fund. Finally, we have Tier 3. This is your long-term fortress. This tire is designed to hold 6 to 12 months of operating expenses, or even more. Since you likely won't need to touch this money for a while, we can prioritize growth and yield. You're playing the long game here. Great options for Tier 3 include short-term bond ETFs or a CD ladder. A CD ladder involves spreading your investment across multiple certificates of deposit with staggered maturity dates. For example, you might have one CD maturing every 3 months. This strategy provides a higher yield than a savings account while still ensuring that a portion of your funds becomes accessible on a regular basis. This tiered structure ensures that you have the right kind of money available at the right time. You have instant cash for immediate problems, accessible funds for developing situations, and a growing nest egg for true, long-term security. Now for our third and final idea, which is a clever way to accelerate your fund's growth exactly when you need it most. I call this the contingency revenue trigger system. Standard operating revenue keeps the lights on. Contingency revenue builds your fortress. What is contingency revenue? It's income from non-core, supplemental activities. For a consulting firm, this might be selling a pre-recorded workshop. For a marketing agency, it could be a one-off consulting gig outside your retainer clients. For an e-commerce brand, maybe it's selling a small digital product like a guide or template. These are revenue streams that aren't part of your day-to-day business model. Here's how the trigger system works. You identify these non-core revenue streams in advance. Then, you set up a rule. Whenever a contingency event happens, 100% of the income from these supplemental streams gets redirected directly into your rainy day fund. Specifically, into Tier 1, your most liquid emergency account. What's a contingency event? It's a financial shock to your system. A major client paying their invoice 30 days late. Losing a contract you were counting on. An unexpected, expensive equipment failure. These are the moments when your financial anxiety spikes. This is where the magic happens. The system is designed so that your fund grows most aggressively precisely when you are feeling the most financial pressure. Let's say a client who owes you $20,000 is late on their payment. Normally, that would cause panic. But with this system, you might have a rule that any revenue from your online course sales this month now goes directly to replenish your immediate cash reserves. So, while you're chasing that late payment, you see a few $1,000s from your course sales flow directly into your Tier 1 fund. It's a psychological and financial relief. It turns a moment of high stress into a proactive, empowering action. You're not just waiting and worrying. You're actively reinforcing your defenses. This method creates a direct link between risk and savings, ensuring that the very events that threaten your stability are the ones that trigger a more robust financial response. It's an intelligent, dynamic way to build resilience right when it matters most. So there you have it. 3 powerful, actionable ideas to build a rainy day fund that can genuinely save your business. First, automate your savings by allocating a fixed percentage of every single revenue inflow. Use your accounting software to make it effortless. Second, structure your savings with the liquidity ladder Tier 1 for instant cash, Tier 2 for accessible funds in a high-yield account, and Tier 3 for long-term growth in bonds or CDIs. And third, create contingency revenue triggers using supplemental income streams to supercharge your savings exactly when you face a financial threat. Building a business is hard enough without the constant fear of a cash flow crisis. Implementing these strategies will give you more than just a financial buffer. It will give you peace of mind. It allows you to make strategic decisions from a position of strength, not desperation. It's the difference between surviving and thriving. If you found this advice valuable and you want to build a rainy day fund that actually works, give this video a like and be sure to subscribe and hit that notification bell for more practical cash flow safety tips. Thank you for watching. Stay prepared and stay profitable.